Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in.
Hello, and welcome back to another episode of the AAA Storage Podcast. I have with me, as always, Paul Bennett. Thank you for joining the show. Today is kind of an interesting episode because we're talking about some real-time information, real-time market data, because, for the last several weeks and months, we've been talking a lot about real estate in general, self-storage specifically, different processes that you guys have at AAA. But today is interesting in that last week, there's been a lot of market turmoil. And so, for example, the S&P right now, currently on Wednesday, April 9th, is up slightly today, but over the last week, last 5 days, is down 11.5%. Last 3 months is down 15%. It's about 1,000 points off its highs just a few months ago. And there's been a lot of volatility. Major stocks are down. And anytime that happens, it's good to kind of level set and talk about risk and talk about correlation, whether that's systemic risk, whether that's tracked to the market in different ways or different vehicles that you're invested in. And so, Paul, I know you have a lot of thoughts around these different things because you have lived through several crises. I mean, think about 2008 and some of the bank failures and things like that going on then. That deeply impacted real estate, as everybody knows. But is this time different? Should we be concerned? There's just a lot of questions, and I think it's good to kind of talk about that in different ways that you see things. So, Paul, I'll turn it over to you. Yep. Tell me a little bit about how you see what is happening right now in the market.
Brandon, it's a super interesting time. Let's start out. Well, I'll give you a little bit of a view of what I think is happening in the market, and this is not new news to anybody, right? This is no deep insight. I think the market is real. The markets don't like uncertainty. Even when the news is negative, if they know what's going to happen, the markets can perform generally pretty well. What they don't like is uncertainty. And the tariff environment, the trade environment, and the disruption of that has created some uncertainty about supply chains, about cost, and in some cases, in some industries, it's not really clear what the impacts are going to be, but the sense is could be significant. And so the market's reacting to that uncertainty. That's I think, fundamentally what's going on. This isn't a political podcast, and I will be politically neutral, but I will say from the standpoint of my own sort of worldview of economics, I understand that anytime I've had to make an important but difficult change in my life or in my business, there has been a period of disruption. And I really think and believe that getting trade on an international level back to a more balanced position where there are not advantages and disadvantages. I think we've been at a disadvantage for 50 years, and that's sort of evolved over a long period of time. That's why we run such big trade deficits with so many other countries in the world. I think it's a good thing to correct that, but I do think it's disruptive. And I think what we're seeing right now is just the process. So we'll have to wait and see how it really turns out in the end. But from a purely economic standpoint, I'm not against nor am I concerned about what we're experiencing. I think it's probably to be expected and could result in some very positive outcomes long term.
Interesting. Okay. I'm glad to hear you say that. Well, not getting political or anything like that, but it's just like encouraging that maybe there's more going on than what you see in some immediate headlines. And thinking long term, there's a lot going on,
Yeah. I am not a Trump apologist. I won't even reveal, I will reveal my politics. I am a fiscal conservative and a social moderate, maybe even a social liberal. And from a fiscal standpoint, from a financial standpoint, I've spent more than 40 years in the business world, in real estate and in corporate finance. There are some basic things that you cannot refute. You cannot swim against the tide. They are what they are. They are economic realities, and And so regardless of who's in the White House, I am supportive of what I think are sound fiscal policies for our nation. Simple concepts like things cost money. So if you want to give more money away, tell me where you're going to get the money to give away. I think anyway, I'm really getting off on a tangent. Probably don't need to go there. Maybe the editors can clean some of that up. But but the reality is, I am not concerned. I think there could be some negative outcomes, and I don't have a crystal ball. I think I was on a show with Paul Moore recently with Wellings Capital, and he said those who believe in crystal balls get to eat glass.
Ooh, I like that.
But sorry, I don't have a crystal ball. But fundamentally, from a purely macroeconomic standpoint, I think trying to reset the environment for the international trade is a good thing, and I'm not surprised that the process has caused some uncertainty and some disruption.
Yeah, okay.
But fundamentally, our economy is as strong as it has been. We'll swing back a little bit more to the things we normally talk about. I got asked today by an investor, were we concerned about tariffs, particularly tariffs on steel? Because obviously the self-storage and office industrial flex facilities that we develop are highly dependent on steel. And the reality is it will have some impact. But if you look at the cost of steel as a percentage of the total cost of a project and assume a 10% increase in the price of steel, it probably results in a 2% increase in the overall cost of the project. So not material and well within the boundaries of the contingencies we build into our construction budgets every day. So we're not expecting it to have a huge impact. I know there are other industries where, that impact could be, more profound. I have two children who are very successful in business. One is in the mergers and acquisition world, and they've seen a lot of hesitancy and sort of deals stopping mid-stride because of the uncertainty. So it's impacting my son, and my daughter is the president of a durable medical device company that's, if not the largest, one of the largest in the country. And they have vertically integrated the manufacture of certain products that they distribute, and they're made in China. And there's $20 or $30 million worth of revenue and profit attached to those products. So they went through the effort to design and find a manufacturing partner overseas and all that. And those costs are getting ready to swing dramatically if this doesn't get resolved. And so it's going to impact them. So there's certainly impacts in certain industries. For self-storage, in the world we live in, the business impacts, at least at this point, look pretty negligible. So
I think what's interesting is something that you were talking about before we started recording, and you were talking about how to assess risk as a real estate investor, because there's ways to think about whether it's a market correlation or whether it's a systemic risk in the actual system of real estate. I'm curious what you mean by that, and if you could talk a little bit about how you're thinking about that, and what I'm gathering is why you're not worried about what is happening because of that kind of risk assessment that you have set. Is that the case?
Yeah. So let's quickly define correlation for a minute, because I think what we really started out, or what I started out, what was on my mind today was the correlation between the public markets and alternative investments, or the lack of correlation. Correlation is simply the degree to which two assets move in relation to each other. Easy one is stocks and bonds. They have a low correlation or maybe even a negative correlation in that typically if stocks are going up, bonds, that's because interest rates are low, the economy's great, and bonds are not as in favor, so they're not as in demand, and rates are low, so they move inverse to each other. But just understanding what correlation versus systematic risk, which is 2008 was an example of systematic risk in an environment where the banks got over their skis and you saw Lehman go to its knees. I'll never forget where I was the day that news broke. And you saw the entire banking system in peril. That was a systematic risk and a black swan event. That is, hopefully will never occur in my lifetime again, and hopefully never again. It resulted in a lot of new regulation and oversight of banks, and and all types of things to help prevent it in the future. But it directly impacted real estate because it directly impacted access to capital. You couldn't borrow money. The banks couldn't loan money. That caused a free fall in real estate values. It caused construction projects to stop mid-stride. People that had bought at that time, we had bought a 17-acre piece of land just outside Charlotte, bought it in 2006. And before we could get it developed, all of this happened. And it was literally, that project is now just nearing completion almost 20 years later. And so, fortunately, we had the ability to hold that land for an extended period of time, pay the taxes. We actually had debt on the land. We paid off the debt. So we just squatted on the land, and we wound up with it's an $80 million mixed-use project, 160 apartment units, and a 55,000 square foot Lowe's grocery store, and about 100,000 square feet of retail.
Wow.
Great project, but it took us 20 years because of what happened in 08, or that was sort of the beginning. But anyway, the systematic risk is a different animal. I certainly don't see any systematic risk in what's happening in the economy and what the markets are. This is not about the banks. This is not about anything that has the ability to directly impact real estate in a traditional sense. And so it's just something to ride through. And the fact that our investments are not correlated to the public markets. That's one of the things I came today with on my mind is there are multiple ways to invest in any asset, right? The tangible assets tend to be inflation hedges, and they tend not to be correlated to the emotion and the volatility of the public markets. A great example of that, I'll give you two. I'll give you a quick one, and then the one I'd rather talk about more because it has to do with self-storage. But the first one's gold. Like if you bought gold 6 months ago, it's worth more than you paid for it 6 months ago. If you bought a gold stock 6 months ago, it's probably up because of the sort of broad view that gold is sort of a safe haven in times like this when things are uncertain. But it might not be, because people are selling stocks because they want to sell stocks regardless of what that business does or what assets it owns. That's not a great one in this case, because I didn't look today, but I probably gold stocks have performed pretty well. Here's a better one. There are about 9 publicly traded vehicles. They're not all REITs, but they're publicly traded companies that are major players in the self-storage space that we live in every day. The names that you would know are CubeSmart, Extra Space, and Public Storage are the 3. National Storage Affiliates is the 4th, and people generally refer to 4 publicly traded REITs. But there are about 3 or 4 other companies. For example, U-Haul is a major player in the self-storage business, and they actually have committed and are expanding their presence in self-storage. And so I looked at those stocks over the last little bit. I looked at them on a 5-day basis as of the close yesterday and a 30-day basis, and I'll go down the list. CubeSmart down 14.6% in the last 5 days, 16.46% in the last 30 days. Public Storage down 10.9% in the last 5 days, down 15.18% in the last 30 days. Extra Space down 14% in the last 5 days, almost 20% in the last 30 days. Let me ask you a question. Do you think the real estate those REITs own has decreased in value over the last 30 days?
I hope not, because my house would be worth a lot less.
I can absolutely promise you it hasn't changed a bit. And it's interesting. You mentioned a minute ago that the S&P was down, I think you said about 15% over the last 30 days. Mm-hmm. If you averaged out the declines over the last 30 days I just gave you for the 4 large publicly traded real estate investment trusts, I'll bet you it averages 15%. Exactly correlated to the S&P decline. So what the reality is, the assets those businesses own, those REITs own, don't produce a dime less cash flow than they did a month ago. They're not any less valuable than they were a month ago. That stock is down 15% because people decided to sell stocks.
Yeah,
And that's the example of correlation. A correlation in a very specific way, and it's not uncommon. There are privately traded REITs that offer the same type of vehicle to invest in self-storage and office and medical office and industrial and all kinds of things. And the privately traded REITs don't have that same share price correlation. They're typically valued based on appraisals that are done of their portfolio on a semi-annual or annual basis. So low volatility. The trade-off is, and I should have mentioned this up front, the reason people invest in REITs is because of liquidity. Access to the public market means I could call my broker, sell my Extra Space stock today, and the money would be sitting in my cash account or my money market fund at the broker in 5 business days. You do not have that kind of liquidity when you're investing directly into real estate, whether you own it yourself, you invest with a fund sponsor like us, and that's the trade-off. And so I am not against owning stocks in our industry that have correlation to the public market. I just think you have to avoid having a false sense of security. If you're looking at your portfolio and you've got a bunch of ETFs and mutual funds, and you're smart, so you've invested in real estate and you've invested in self-storage, but you've done it through buying stock in one of these publicly traded REITs, you're not as diversified as you think you are, because everything you own is correlated to the emotion and the volatility of the public markets. And I think I've said this before in some of our conversations. I am an absolute firm believer, and my own personal portfolio would reflect this, that any person of substantial net worth, if you're an accredited investor, you almost have to have an allocation in your portfolio that's direct into, I think, real estate. I mean, I think you can have some venture capital stuff. You can have some pure private equity stuff. You can have gold. Those are all assets that are not correlated to the public markets. All of them are good. I think in terms of the risk pyramid, right? I don't know if you can picture it, but treasuries are at the bottom of the risk pyramid. Commodities are at the top. And it's sort of stratas of risk and return going up the pyramid. If you're looking at an allocation to non-correlated assets, real estate is at the bottom of that risk pyramid. So I think almost every portfolio, whether you like self-storage or not, whether you want to invest in multifamily, office, retail, I just am a firm believer that you need to have an allocation. And the other thing, and I'm an opinionated guy today, aren't I? But the other thing is, I think a lot of investors are getting advice or guidance from people whose objective is investing for beta. And that's a very defensive posture in my mind. It's a good way not to lose money, but it's also a good way not to build wealth. And one of the things that we're very focused on in what we do is investing for alpha, which is, trying to get outsized returns on a risk-adjusted basis. And you don't have to do that across your portfolio. And certainly where you are in that journey depends on where you are in age and retirement and overall net worth. But at least a portion of your portfolio ought to be invested for alpha, not beta. And so that's my opinion.
Okay, this is very helpful. So if I could summarize, there are trade policies and tariffs that are entering into the world and causing disruption and chaos and uncertainty. Markets do not like that. As a result of that, we see a lot of declines across your broad markets, S&P, Dow Jones, NASDAQ, across the major blue chip stocks like Apple and many other in the public markets. And what some people think is, I should diversify my portfolio and I put money into REITs because I need to be in real estate. But that is a false sense of diversification because there's actually not an underlying asset or direct investment in real estate. It's just in a stock that is correlated to the S&P 500.
Well, I want to correct you right there because they are invested in real estate.
Yes, correct.
Public Storage is the largest owner of self-storage facilities in the country, maybe in the world.
Right.
But the problem is the vehicle that you've chosen to invest in them or with them in is subject to the emotional volatility of the overall market.
Okay, fair. Yes, fair, true. Okay. So, but it would be better, what you're saying is you could have more peace or, I'll just say peace in a market turmoil like this, like we're experiencing now, if you had more direct investments in something like real estate or gold or something like that. But Okay. So that is, as a result, you feel a lot of, you feel more comfortable than the headlines would suggest in a lot of the major papers right now over the last week.
Yeah, there's another game going on behind the scene. The current administration is trying to leverage the Fed to get rates down. There's a major refinancing of federal debt that's looming, and part of what's happening is a little bit of gamesmanship, trying to put some pressure on the Fed to lower rates, which I'm all for. Obviously, in our world, lower rates are a good thing generally. If there is a real threat of inflation, it was already baked in. This trade war, it might be the straw that breaks the camel's back, but I don't think so. I think if there's a recession on the horizon, I don't really buy it. The economy's been pretty resilient on the whole. It was already baked into what's happened over the last period of time, and recessions aren't necessarily bad either. It sort of shakes things up and repositions things and creates new opportunities and creates a little pain. Like I said at the very beginning, disruption and change is always difficult, but it's a part of the cycles, just like down markets are part of real estate cycles, and they're unavoidable and they come and they go. We invest, for the intermediate to long term. I'm too old to worry about it anymore, Brandon.
I'll end the show there. That's perfect. Thank you. I'm going to take your advice, and I'll try not to worry myself, but we'll see how it goes. So, Paul, thank you so much for your wisdom and experience, because I am, as I've said before, I'm young, so I appreciate you having been through this a time or two and giving me some comfort. So I appreciate that. I hope our listeners feel the same. So we will see you next time in a few weeks, and we'll catch up then. So, Paul, thank you, and we'll see you then.
That sounds great, Brandon. Always enjoy, buddy.
See you, man.